Okay, let's dive right into a topic that is, well, absolutely essential for the California Legal Specialist exam, powers of appointment. You've got to master these, there's just no way around it. So we're going to break them down piece by piece so it all makes perfect sense.
So what on earth is a power of appointment? You should really think of it as a secret weapon for any estate planner. It's this amazing tool that builds incredible flexibility into a plan, letting it adapt to whatever life throws at a family years down the road. And if you use it right, it can unlock some really significant tax advantages.
To get a handle on this, we have to start with one single fundamental idea. Every single power of appointment falls into one of two buckets. It's either general or it's special. Seriously, getting this one distinction down is the key to unlocking everything else.
All right, let's make sure we're all on the same page with the lingo. The donor, that's the person who creates the power, usually in their will or trust. They give this power to the donee, who we also call the power holder. And what is that power? It's the authority to decide who actually gets the property. You're basically delegating a huge decision to someone you trust, maybe decades later.
Okay, so here's that core difference in action. A general power of appointment, or GPOA, is incredibly broad. I mean, the holder has so much control that for tax purposes, the IRS basically treats them as if they own the property outright. Now, on the flip side, you have a special power of appointment, or LPOA, and it's all about being limited. And it's those limits that give you that critical tax protection.
So let's zoom in on these GPOs. I've got a simple memory aid for you that I like to call the Rules of Four. This is such a great way to quickly analyze any power you see on the exam and figure out if it crosses that line into general territory. Okay, here's the first test. A power is general if the holder can give the property to any one of four groups: themselves, their estate, their creditors, or the creditors of their estate. And listen, if they can appoint to even one of those four, you're looking at a GPOA. And that means tax consequence red flags should immediately start waving in your mind.
So why is this general label such a big deal? Well, in one word, taxes. The Internal Revenue Code is very clear that a GPOA triggers a taxable event in one of four situations: just holding it at your death, exercising it, releasing it, or even just letting it lapse. Any one of these can create some major estate or gift tax headaches.
Now, let's look at the other side of the coin, special powers. Unlike that broad taxable GPOA, a special power is all about limits. It's those very restrictions that keep the property out of the power holder's taxable estate, which makes it a much more tax-efficient tool.
And this, right here, this is the magic language for the exam. The HEMS standard: health, education, maintenance, and support. This is what turns a potentially dangerous power into a safe one. This is especially true when a trustee is also a beneficiary. If a trustee's power to make distributions to themselves is limited by this ascertainable standard, it is not a GPOA. Plain and simple. You know, California law actually gives us a statutory safety net here. Probate Code 16081 basically steps in to stop a trustee beneficiary from having a GPOA by default. But, word to the wise for your exam essays, relying on the statute is never, ever as good as having that clear, precise HEMS language drafted right into the trust document itself.
All right, let's get into the fun stuff, the advanced strategies, and the common exam pitfalls. This is really where you can show the graders that you have a deep, practical understanding of how all these powers really work.
First up is the 5 or 5 power. Now, we just said that letting a GPOA lapse is a taxable event, right? Well, this is a huge exception to that rule. It lets a beneficiary pull out up to the greater of $5,000 or 5% of the trust assets every single year. And here's the kicker. If they don't, and the power just lapses, it is not a taxable gift. It's a fantastic way to provide flexibility without that big tax hit.
This brings us to a really fascinating, and I promise you, a very testable advanced concept. Imagine this. You have an asset that's shot up in value, but it's stuck inside an irrevocable trust, like a bypass trust. Now, it's safe from estate tax, which is great, but the kids are going to face a massive capital gains tax bill when they sell it. So is there a way to, trade one tax for another? Yes, there is, and it's called the Delaware tax trap.
So here's how this clever move works. You take a special power of appointment and you exercise it in a very specific way. You use it to create a new power of appointment. Now, under the tax code, doing this one specific thing intentionally triggers estate inclusion. The assets are now pulled into the power holder's taxable estate, and voila, at their death, those assets get a brand new step up in basis, completely wiping out all those embedded capital gains.
So for the exam, you've got to remember this pro tip. The Delaware tax trap is not a mistake. It is a sophisticated, intentional strategy. You are deliberately causing estate tax inclusion because you want to gain a much more valuable income tax benefit. It's a classic planning move, especially now when estate tax exemptions are super high and capital gains are a much bigger worry for most families.
Okay, let's bring it all home and lock in the key takeaways for the exam. This is the stuff you absolutely need to have at your fingertips when you sit down for that test.
Think of this as your personal cheat sheet. A GPOA gives you broad control. You can appoint to yourself or your creditors, and because of that, it's taxable. An LPOA is the exact opposite. Its control is limited, it restricts who gets the property, and as a result, it's generally not taxable, especially if you see that HEM standard. You have to know these differences cold. So, when you see a power of appointment on an exam question, I want you to run through this mental checklist. First, identify the type. Is it general or special? Look at who the power holder can give the property to. Second, if it's a trustee who is also a beneficiary, hunt for that HEMS language. Third, analyze for any taxable events. Is the power being held, exercised, released, or is it lapsing? And finally, always be on the lookout for those advanced issues like the 5 or 5 rule or the Delaware tax trap.
So, which is it in the end? Is it a simple tool for flexibility, or is it a complex trap just waiting for the unwary? Well, as we've seen, the answer is it's both. It's an incredibly elegant tool, but it is absolutely loaded with pitfalls. Understanding that duality, that's your real key to acing these questions on the exam.